Hey everyone, welcome back to Corporate Decoder, the place where let's just say sometimes big companies decide to sell themselves, and the paperwork is surprisingly exciting. Today, we're diving into Hillenbrand Incorporated's latest report. It is not your typical earnings update. This filing is all about a massive deal, a potential sale of the company itself. We're going to break down what this means, especially the juicy financial bits that usually get buried. Before we get into the nitty-gritty, if you're already enjoying our no-nonsense corporate breakdowns, make sure you hit that subscribe button. And if you want to chat with us and other finance enthusiasts, join our Discord community. The link is in the description below. Okay, so what is the big story here? Hillenbrand Incorporated, a company that has been around for a while, is looking to be bought out. They've inked a deal, an agreement and plan of merger as it is called in fancy corporate speak. This means another company, one that seems to be affiliated with Lone Star Funds, is planning to acquire them. So what exactly are they agreeing to? Think of it like this: Merger Sub, which is just a shell company created for this purpose and owned by an affiliate of Lone Star, is going to merge with Hillenbrand. After the dust settles, Hillenbrand will still exist, but it will be owned by the parent company, also an affiliate of Lone Star. This is a pretty common way for big companies to buy other companies. The important part for us is what happens to the shareholders, the people who own pieces of Hillenbrand. The deal on the table is pretty straightforward for the shareholders. For every share of Hillenbrand as common stock they own, they're going to get $32 in cash. That is it. No stocks, no complicated exchanges, just cold hard cash. This amount is called the merger consideration. It's important to note that this cash payment does not include any interest. Now, what about the folks who have stock options? These are like promises that allow people to buy company stock at a certain price. If an option lets you buy stock for less than the $32 buyout price, that option becomes valuable. The person holding the option will get the difference in cash. For example, if you had an option to buy shares at $10 each and the buyout is $32, you get $22 for each share that option covers. But if the option price is $32 or more, those options are just cancelled without any money changing hands. That is a bit tough for those option holders. Then you have restricted stock units, or RSUs, and deferred shares. These are essentially promises of stock that vest over time or based on performance. For any of these that are outstanding, whether they be fully vested or not, they will also be converted into a cash payment. It will be the $32 per S-share multiplied by the number of shares covered by the RSU or deferred share award. Again, any required taxes will be withheld. This is pretty standard for acquisition deals. For the really complex ones, the performance-based restricted stock units, or PRSUs, it gets a little more interesting. These are cancelled for a cash payment based on $32. Per S-share, the number of shares used for this calculation will assume that the performance goals have been met, at least at the target level or the actual performance level, whichever is higher. This part is a bit softer for these particular award holders, making sure they still get compensated even if performance targets were tricky. This deal was agreed upon on the 14th of October 2025, and it's a significant one. It's not a done deal yet though. There are a bunch of conditions that need to be met before this merger can actually happen. One of the biggest hurdles is regulatory approval. They need to get the thumbs up from antitrust regulators like those under the Hart-Scott-Rodino Act, which basically checks if this sale would make the market unfair. They also need approval from something called CFEIs, which is the Committee on Foreign Investment in the United States. This looks at the national security implications of foreign acquisitions of US companies. So there are definitely some governmental checks and balances here. And critically, Hillenbrand's own shareholders have to vote and approve this deal. The company's board of directors unanimously recommended that shareholders vote yes. This is crucial because if shareholders don't agree, the deal falls apart. While all this is going on, Hillenbrand has some restrictions. They generally can pay out dividends to their shareholders. However, to an exception, they are allowed to pay one cash dividend before the end of 2025, but it can be more than $0.2275 per S-share. This is likely to allow them to distribute some cash to shareholders before the deal closes. Now, let's talk about the breakup fees. These are pretty substantial. If Hillenbrand decides to walk away from the deal under certain circumstances, or if the deal falls apart because they found a better offer and accepted it, they might have to pay the buyer a hefty fee of $69 million. That's a lot of money designed to discourage Hillenbrand from backing out if they get cold feet, or find someone willing to pay more. On the flip side, if the buyers, parent and merger sub decide to walk away under specific conditions, they might have to pay Hillenbrand a termination fee, and this one is even bigger, $138 million. It is double what Hillenbrand might have to pay. This is likely to ensure the buyers are serious and committed too. So, where is all this money coming from? The acquiring entity parent has secured the necessary funding. A significant chunk, $1.647 billion, is coming from equity contributions. Lone Star Fund III, referred to as the sponsor, is putting this money in. This shows that private equity firms like Lone Star are ready to invest heavily in companies like Hillenbrand. On top of that equity, they've also lined up a massive amount of debt financing. We're talking about nearly $1.9 billion in a senior secured term loan facility and other credit facilities, including a revolving credit facility, a bridge loan facility, and a letter of credit facility. Cumulatively, this is a huge amount of debt being taken on to finance this acquisition. This highlights how acquisitions are often funded through a mix of equity and significant borrowing. And to add an extra layer of security, the sponsor, Lone Star Fund XIV, has provided a limited guarantee. This means if the buyers fail to meet certain obligations, like paying that $138 million termination fee, the sponsor will step in and ensure it gets paid. This gives Hillenbrand more confidence that the deal will go through as planned. Now, if you're a Hillenbrand shareholder, keep an eye out for more information. The company will be filing a proxy statement with the SEC. This is a document that explains the merger in detail and tells shareholders how to vote. It's really important to read this document carefully when it comes out. You can usually find these filings on the SEC's website or directly from the company's investor relations page. This section is about who might be influencing things. It basically tells you who the key people are at Hillenbrand, directors and executives who might be considered participants in encouraging shareholders to vote a certain way on the merger. It points to other SEC filings where you can find details about their stock ownership and compensation. This is standard disclosure to ensure transparency and prevent any conflicts of interest from going unnoticed. And finally, the report is signed off by Nicholas R. Farrell, who holds a senior position at Hillenbrand, serving as Senior Vice President, General Counsel, and Secretary. This signature signifies that the company is officially submitting this report, confirming the accuracy and completeness of the information within it to the best of their knowledge. So, diving into this report, what is the big picture for Hillenbrand? They are entering a takeout deal, meaning they are being acquired, and the price is $32 a share in cash. This is attractive because cash upfront is certainty for shareholders. The financing from Lone Star looks solid with a significant amount of equity and a substantial debt package totaling over $4 billion in funding commitments. This suggests Lone Star is very committed to this acquisition. However, the company's own ability to pay dividends until the deal closes is restricted, except for one small payment. The termination fees, especially the large one payable by the buyer, add a significant layer of commitment to this deal. The key will be the shareholder vote and the regulatory approvals. What are the risks? Well, regulatory hurdles are always a possibility. If antitrust or national security reviews raise concerns, the deal could be blocked. Also, despite the board's recommendation, there is always a chance shareholders might not approve. For Hillenbrand's management and employees, this is a period of uncertainty as they navigate the transition. For investors, for now, it looks like a straightforward cash out in conclusion. Hillenbrand is on the verge of being acquired by an affiliate of Lone Star Funds for $32 per share. This deal, backed by significant financial commitments from Lone Star, represents a major liquidity event for Hillenbrand's shareholders. The main things to watch are the shareholder vote and the regulatory sign-offs. Alright, that is our breakdown of Hillenbrand's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.